Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to have a little discussion about an investing topic which might be relevant to a bunch of you, which pertains to if you've got a bunch of money, do you put it all into the market now? Do you put it in a little bit over time? Basically there's this expression they say, time in the market always beats timing the market. And we're going to discuss, is that accurate? Is it not? How does it work? And how does it apply to what your investment decisions do? Because I know I'm talking to a lot of clients and friends who have a lot of cash sitting on the side, and they're like, okay, well, how do I allocate it? And things are expensive. They're worried about what to do with it. They're worried that, hey, they might be buying the top. That would be bad. And so what's the best strategy? I'm going to try and help navigate you through a strategy that should work to give you a little bit more effective approach. And so we're going to dive into that. Before that, if you haven't already, please smash the subscribe button, click the notification bell to make sure you don't get missed out on any of these other videos. If you're interested at all in these topics of international tax planning, asset protection, how to pay the lowest legal amount of tax possible, getting second residencies, citizenships, passports, moving abroad, forming companies, opening bank accounts, etc., international investing, reach out to me. You can book a call, clarity.fm/Michael Rosmer. There's a link below. Or you can visit our websites, offshorecitizen.net, offshorecapitalist.com. All right, let's get into it. So as I said, there's this expression. There's actually quite a few studies on this that suggest that time in the market always beats timing the market. Now, as some background on this, you can look at charts and you can see that actually the majority of the returns in a typical portfolio take place in very small windows of time, okay? So in other words, you have a lot of kind of like, flat, mediocre, and then you'll have like short bursts of growth. And the opposite is also true, okay? Like over the course of, 5 years, the number of days that are responsible for the majority of the losses is very few. Like if you remove the top 12 lost days, if you could pull those out, your returns get magnified dramatically, okay? Now what's the problem? Is it's really, really hard to time the market, okay? Very hard. Most people are not gonna be able to time the market. It's a nice idea that, hey, listen, I could buy just before it pops and I could sell just before it drops, but for most people, that's difficult. Now, I have some friends and people who I do business with, etc., who are extremely good at this, right? Extremely good. I've watched them buy the bottom pip on a bunch of different assets, as well as sell the top in multiple occasions. And some people who are day traders, etc., that makes sense. All right, you can get into looking at many, many indicators. You can learn to read different chart patterns, etc., and start to have some sense of what's going on. But for most people, that's just not going to be practical. If you are interested in that, reach out to me. I can suggest some trading resources you can check out that are really solid. If not, no problems. I certainly am not the one who's doing that. But that being said, I do think that there is some middle ground, okay? And here is where the fallacy lies. The fallacy lies in the idea that people would dollar cost average from cash into some asset like stocks, for instance, okay? And I think that's inherently the wrong attitude. The attitude should be, we're always invested. The question is, what are we invested in? Holding cash is a form of investment. Now, it's an investment that over time is going down, right? But, there are times when the best risk to reward place to be is in cash. There are times when the best risk to reward place to be is in some sort of fixed income, some sort of bond, some sort of loan, etc. Sometimes it's best to be in real estate. Sometimes it's best to be in stocks. Sometimes it's best to be in crypto. Anyone who comes along, like this is kind of one of the most common fallacies or pieces of idiocy that I see from people who don't understand investing at all, is they basically go in, they're very asset class focused. So I'll see in some Facebook groups, somebody will say, hey, how should you invest? Somebody will be like, oh, you should buy real estate. Oh, you should buy crypto. The reality is that there's a great expression, don't tell me what to buy, tell me when to buy it, right? If you had bought crypto in 2017, you did great. If you bought crypto in 2018, you did horrible, right? And I can pick any given asset class, you can look at the same thing. This year, if you'd bought Tesla, you did amazing. Turns out if there was some other periods of time, if you'd bought Tesla, it did nothing for a few years on end, right? Like what to buy is not just as important as when to buy. So you should have some degree of attention that you're paying to timing, okay? But that does not mean you're trying to pick the bottom or trying to pick the top or whatever. Instead, what I would suggest is that you should take an asset allocation approach. What does this mean? At any given period of time, there are certain assets that are up and there are certain assets that are down. So it turns out that, this is late December that I'm recording this in 2020, and Dow Jones was previously over 30,000. It's come down a little bit, but not substantially. It's still close to all-time highs, right? S&P, NASDAQ, etc. If you look at the tech stocks, all near all-time highs, etc. Even earlier this year, we had like record breadth, meaning that the difference between growth stocks and value stocks had pretty much never been further. You had, for instance, I was advocating and buying some of the oil industry when it was, record lows. Like it hadn't been this low since 2002, right? And whereas growth had gone way up. Now, it turned out since then, oil rose about 60%, right? Some of these indexes, et cetera. And so it's no longer cheap, right? The Russell index doubled in a pretty short period of time. So there's all these different things that those don't really make sense, right? And obviously, whatever time you're watching this same principle will apply. At the same time, it was kind of obvious to buy, say, oil at that point in time because everything else was up and oil was down, right? So if you just do this, there's a very famous guy, Dr. Robert Shiller, who created something called the CAPE index. So it's a cyclically adjusted, it's not an index. The CAPE metric, it's cyclically adjusted price earnings ratio, and he keeps track of on a country by country basis. And it's just a way of determining, hey, our market's overpriced or underpriced, right? And he's like, hey, look, if you just buy what's underpriced typically and sell what's overpriced, generally speaking, you'll do a little bit better than the market. And so, for instance, right now, by virtually every metric, the US markets stock markets in much of the world broadly are very expensive, right? So if I'm dollar cost averaging in right now, am I going to dollar cost average into something that's probably close to the top? No, probably not, right? Instead, what I'm going to do is I'm going to dollar cost average into the things that are, maybe fixed income, right? So I'm saying, okay, great, I can put my money into some sort of an arbitrage fund. I can put it into some sort of asset that's going to pay me cash flow. Now, maybe I want some liquidity because I'm thinking, it could be that we're going to see a decline and I want to be able to pull that money out and reallocate it. That's fair enough, right? There's certainly something to be said for that. But I want to be in things that right now I'm able to, I'm not buying the top, right? And then as it changes, I'm going to switch. So where I'm allocating my capital is based on what is relatively cheap based on its value. Now, this requires some sense of value. And this is one of the things that I think people don't really get. People will say it's hard to time the market. Yeah, that's a lot of truth to that, right? It's, especially if you're calling tops and bottoms, very, very hard, okay? But it's not that difficult to say what is cheap and what is expensive, okay? These things are not so hard. So for instance, Tesla is about $500 billion. Tesla is expensive, okay? How do you know that? Well, by historic terms, it's just gone up really high, really fast. And when things tend to go up really high, really fast, they tend to underperform in the future. Not always, you might not have caught the full range, but typically, right? The opposite is also true. When something that is solid has just dropped really fast, really far, it tends to recover quite quickly, or it tends to be a good buy. So in that sense, you can pay attention to how these things go. You can also pay attention to, compared to its actual earnings and market cap potential, is it expensive? So when I look at Tesla, again, let's use them as an example. Tesla has a market cap which is greater by far than the entire car industry combined. Okay, all of the car industry combined, it's more than, quite a bit more than the whole industry. Okay, so you can sit there and you can say, well, hang on a minute. It may be worth that in the future. Okay, but how much can it grow from there, right? If you're saying, hey, I'm already, in theory, what you're saying is, hey, this one company is going to make the profit of the entire industry combined. Now, this is a company that's not making hardly any profit at all right now. So let's look forward. How long will it take for them to reach that point that they're assuming all the industry's profit, right? 10 years? 20 years? keep in mind that that would justify the current price. That's not going to justify a doubling of the price. It's not going to justify a quadrupling of the price, etc. Yeah, okay, you know, they're in the battery industry. We can have a whole conversation about Tesla. But the bottom line is that by virtually any valuation metric, including Elon Musk's statement about it, right? Elon Musk is selling Tesla shares, and Elon Musk has tweeted that he thinks the price is that the stock is overpriced. So, you know, these things should all be indicators. Right now, not a good time to buy, right? In the future, maybe those numbers will adjust. Maybe it will be a good time to buy. There's other things that, you know, if we were to look at, for instance, Zoom, right? So Zoom has dropped, I think it's like 32% or something as of today. I think that was the number that I saw from its peak. Now, did Zoom get overpriced? Probably, you know, that's probably the case. But it's down from that point. So we know at least that it's down, right? That's good. Better to buy when it's down than it's up. Better to buy, you know, ticks downward than to buy ticks upward. What's the flip side? What's another example of this? CD Projekt Red, video game company, had a bad release with Cyberpunk 2077, and their stock dropped like 40%, right? Okay, well, what does that tell you? That tells you it's down. Does that tell you that it's going to go up? No, that doesn't tell you what's going to happen. That doesn't tell you, hey, it can't drop further. It doesn't tell you any of that. But at least you can see, hey, it's had a big drop. Generally speaking, if an asset is a solid asset and it has had a major drop in a fairly short period of time, it's a better thing to buy than if it's an asset that has just had a big run up in a fairly short period of time. Generally speaking, that's kind of the way that I would approach it. Okay. So anyway, I hope that kind of gives some sense that basically the idea here is rather than trying to pick the top, rather than trying to pick the bottom, you're going to move money or allocate money into things that are down and away from things that are way up. And if you play that game, you're going to be relatively safe. Does that mean you're going to get, you know, Warren Buffett returns? No, not necessarily. But you're at least, there's always, I guess the lesson is, there's always something which is a pretty good deal. And if there's not something that's a pretty good deal, it's probably a good time to sit in cash and go from there. So anyway, I hope that helps. If you guys have some questions about that, if you have some comments, let me know. Put it in the comments below. Would love to hear from you. Would love to hear what you're looking at. Always interested in investing, where to put capital, and, you know, how to realize decent returns, etc. I'll try to do some more videos on this in the future. If you liked the video, please give it a thumbs up. If not, please tell me in the comments. If you haven't already, smash the subscribe button, click the notification bell, and by all means, like I said, if you're interested in international tax planning, how to pay the lowest legal amount of tax possible, asset protection, company formations, bank account openings, residencies, citizenships, all this international investing stuff, reach out to me, clarity.fm/Michael Rosmer. There's a link below, or you can visit our websites, offshorecitizen.net, offshorecapitalist.com. I will see you guys on the next video.